This is just what I view as the second inning of a nine-inning game for Tesla. And I think ultimately now you're starting to see demand stabilize and I think ramp, especially in China and the US.
That was Daniel Ives, a managing director and senior equity research analyst covering the technology sector at Wedbush Securities since 2018. But besides that, he is also known as a Tesla bull. In his astute analysis, Ives perceives Tesla's recent exceptional delivery figures as the inception of a remarkable electric vehicle triumph that is gradually gaining recognition on Wall Street.
Prices, now look, Musk didn't take off any more price cuts, which why the stock knee-jerk got hit a bit, but they're not going to put their back against the wall. And I ultimately believe 95 to 98% of price cuts are in the rearview mirror. And now you start to get that sum of the parts story from superchargers to AI/FSD, talk about the OEM that they're in talks with, to battery technology. And I believe this is a stock that continues to go higher despite this knee jerk after what's obviously been a parabolic year.
Comparing the competition, Ives portrays Tesla as a strategic chess player while other electric vehicle manufacturers are merely playing checkers. Throughout his consistent support, Ives has consistently showcased his bullish sentiment towards Tesla, demonstrating unwavering faith in the company's ability to sustain its upward trajectory of growth. Amid consistently fruitless predictions over full self-driving and regularly weakening margins, Tesla has carved out a strong year, especially given the hard bumps the company's stock had in 2022.
But Dan, you were already, of course, bullish on Tesla with a $300 price target. You bumped it to $350. What specifically stood out to you from this earnings report or from the earnings call that warrants a $50 price target bump?
Yeah, I think ultimately it's really become the autonomy of electric vehicles in terms of everything that they're doing, because now from a valuation perspective, it's some of the parts. It's not just from a demand, from an auto, from a delivery. I view now you start to add what the battery technology could be, what superchargers could add, and ultimately the drum roll. And I believe this is how you get to $1.5 trillion, $2 trillion market cap. FSD AI.
It is no secret that the past couple of years have been a roller coaster thrill ride for Tesla investors. After surging to a new all-time high in late 2021, the stock went on to crater more than 70%. Factors driving some of the steep drops include outsized inflation, rising interest rates to help fight inflation, and a sizable stock market slump focused largely on tech growth stocks. And yet, Tesla stock is ascending in 2023, up 90% so far this year. While a general stock market rebound and a more bullish attitude on Wall Street this year were no doubt contributing factors, several company-specific developments have thrust the electric vehicle maker back into the spotlight. The biggest of these is the mad dash by a growing number of automakers to join the Tesla Supercharger network and adopt its North American Charging Standard NACS connector, which is quickly becoming the de facto industry standard. Simply put, Tesla has been making waves throughout 2023, particularly over a series of game-changing announcements of partnerships with a handful of competitors that would grant other automakers access to Tesla's supercharging network. These partnerships, amid the regular growth of the charging network, represent a component of the EV maker's business that Wedbush analyst Dan Ives thinks has a lot of room to grow. Historically speaking, automakers have been fiercely competitive when it comes to EV charging, with most players insisting on developing their own proprietary systems. In recent months, however, a long line of rival automakers have thrown in the towel and agreed to join Tesla's supercharger network. Ford Motor Company was the first to break with tradition back in May, and it was quickly followed by General Motors and Rivian. A number of other automakers joined the trend in rapid succession, including Volvo, Polestar, Mercedes-Benz, and Nissan. This veritable stampede has Wall Street furiously reworking its analytical models, and Wedbush veteran technology analyst Dan Ives said he believes this trend will eventually add tens of billions of dollars in additional revenue to Tesla's results. Now, here's the thing. Ives called Tesla a golden EV success story. He highlighted the growing adoption of Tesla's supercharger network and added, "We expect more names such as Hyundai, Honda Acura, and other large OEMs to follow suit." Tesla is also working to secure its share of $7.5 billion in U.S. government subsidies designed to accelerate the installation of as many as 500,000 high-speed chargers on the country's busiest highways. The Biden administration has been clear that Tesla would only be eligible if other automakers were granted access to its network. Spending on Tesla's supercharger network has been significant, with charging stations costing a hefty $42,000 per connector. The resulting financial burden aside, Tesla stations are much more cost-effective compared to the $100,000 to $250,000 per connector spent by rivals, according to a report by Bloomberg. Ives notes that earlier this year, Tesla agreed to add 7,500 superchargers to its network by 2024, more than doubling its current capacity of roughly 5,000. He suggests that the increasing number of deals with other automakers will accelerate its growth. Tesla's network is almost entirely solar-powered, so the energy generation costs are negligible. As a result, Tesla's supercharger network will represent a large monetization opportunity and account for roughly 3 to 6% of total revenues, translating to a $10 billion to $20 billion business by 2030, according to Ives. This implies that Tesla stands to generate total revenue of more than $333 billion by the end of the decade across its sprawling business, a hefty increase from the $94 billion it reported over the trailing 12-month period. To dive deeper into this sum of the parts valuation, we modeled and projected out Tesla's supercharger network. I've said in a post. Ultimately, we estimate that Tesla's supercharger business will be roughly 3 to 6% of total revenues, translating to a $10 billion to $20 billion business annually by 2030. Ives has previously been bullish on the company, raising his price target by $50 to $350 in July. Tesla right now, it's their world. Everyone else is paying rent, Ives told CNBC. Relative to scale, relative to what we see on batteries, this is what I view as Apple 2008-2009 relative to the broader Tesla story. This latest projection out of Wedbush is based on a business that is currently in operation. ARK Invest, meanwhile, said in April that Tesla's robotaxi business could bring in up to $10 trillion in revenue by 2030. ARK said at the time that it expects Tesla to trade at $2,000 per share by 2027. Tesla should trade like a technology stock and not like traditional automakers, something that analyst and Tesla bears can't grasp, said Wood. Though ARK is bullish on Tesla as an AI company, the big vertical it is so optimistic about involves the aforementioned autonomous taxi business, which ARK thinks could lead up to $10 trillion in revenue by 2030. According to ARK's latest research published in April, Wood expects Tesla to reach $2,000 per share by 2027. That's based on a weighted probability of different outcomes for revenue, profitability, and the stock's expected valuation. But even in ARK's bear case scenario, the firm believes the stock could be worth $1,400. These assumptions are ultimately rooted in Tesla's leadership in artificial intelligence and its data gathering to make its self-driving technology better than human drivers. As a result, ARK expects most of Tesla's profits to come from the robotaxi business by 2027. According to ARK's analysis, Tesla could generate over $1 trillion in revenue by 2027, with 44% of that coming from robotaxis and 47% from electric vehicles. The rest would come from energy solutions, human-driven ride-hailing services, and insurance. This view of Tesla as a tech giant rather than a car maker is shared by Wedbush's Dan Ives, who recently projected that Tesla's supercharger network could bring in up to $20 billion in annual revenue by 2030. Bulls have disruptive technology, and that continues to be the big debate around the name, Ives said. I've always viewed them as a tech play, and I can argue the FSD angle makes them one of the best AI plays when you look down the road 3 to 5 years. Overall, as a result of Tesla's stock price surge so far this year, there has been a commensurate increase in its valuation. That said, Tesla is still the dominant EV supplier in the US and is expanding on numerous fronts, including its supercharger network, battery production, energy solutions, and vehicle manufacturing. For those with an extended investing time horizon and the stomach for some volatility, there's still plenty of growth to be had. It is no secret that Tesla stock can be extremely volatile, but experts always point out that it is more suited for long-term investors rather than short-term ones. Make sure to subscribe for more.